Those who forget their heritage, betray the motherland, and seek to split the country will come to no good end.
There should be absolutely no illusions that the Taiwanese people will bow to pressure.
The central government will take full account of Hong Kong's unique status, especially her status as an international financial center.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Goldman Sachs cuts its U.S. growth forecast. The bank cites a lagging recovery in consumer spending. This hour, we speak to Goldman's Peter Oppenheimer. Bank of England officials send more hints of a looming rate hike. The governor, Andrew Bailey, warns of potentially very damaging inflation. And Hong Kong Chief Executive Carrie Lam defends the city's status as a global financial hub. More from our exclusive interview this hour. So first thing is first. First of all, happy Monday. I hope everyone had a wonderful weekend. It's going to be a busy week because of all the number of things that we're expecting, not only earnings, but there's talk, of course, about M&A. And then we look at the fate of the IMF chief, Ms. Georgieva. Now, this is the markets as we see them. First of all, the European stock 600, a bit of pressure, but overall there does seem to be a bit more confidence in the inflation prospects with a lot of the hikes, for example, from the Bank of England being already priced in. You can see a similar loss for the S&P futures. Crude, now this is very significant because look at that, $81.06. There's a psychological level of 80. We hadn't hit 80 since 2014, so that goes back to the supply concerns or certainly the energy crisis. And of course, this has an impact on a lot of companies, which we're seeing a little bit of downward pressure. And then the iron ore, this is a Singaporean one. We could have also shown you the Chinese-based one, but it's gaining some 10% on some mill margins that could actually lead to more demand ahead. If we break down the countries, country by country, and have a look at the European map, I don't think there's a huge difference between, for example, the UK. There you go. The map is up between the UK, that's gaining some 0.2%, to, for example, some of the others across Europe. Maybe the UK holding up a little bit better because of the commodity-rich. This is, of course, an index that's very reliant on some of those, and the CAC 40 down some 0.1%. The DAX also losing by a similar amount. Now, Goldman Sachs has cut its forecast for U.S. growth. Economists led by Jan Hatzius have downgraded growth for this year by 0.1% and their 2022 prediction by 0.4%. Now, they blame a delayed recovery in consumer spending as well as fiscal slowdown for the change. We're joined now by Peter Oppenheimer. He's Chief Global Equity Strategist at Goldman Sachs, an almost 20-year veteran of the firm. He's also known as the godfather of stocks. That's quite a title. Peter, in 2020, he published a long goodbye and analysis of market cycles to much acclaim from the financial community. So as always, Peter, thanks so much for coming on. You make us smarter on all the equity calls that you make. Give us a sense, first of all, of how you're concerned or not about U.S. equities, given the cut to the cut that Goldman did to actually U.S. growth.
Hi, Francine. Thank you for having me. Well, I think that cut reflects, in a sense, the anxiety that the markets have been pricing for just a while now. This combination of slowing growth, partly reflecting supply chain issues, and also the relative weakness still of services demand, the headwinds to fiscal policy, but aligned to that also the stickiness of inflation that, as you just reported, is leading to expectations of an earlier liftoff. So it's that combination that people often describe as stagflationary that has really taken over as the narrative from the reflation dominated market perception that has marked most of the last year. And that sort of combination is clearly less positive for equities. But I do think we need to bear in mind that profitability has remained remarkably strong. Secondly, real interest rates are still negative, and that's supporting equities, at least on a relative basis. So although we do think there's going to be lower returns moving forwards, we're not overly concerned about the downside risk to equities from here.
So what does that mean, Peter, in terms of what you want to buy in this kind of environment?
We've been arguing for quite a pro-value orientated approach to portfolios for some time. mainly because we expected that any rise in bond yields and inflation expectations would really support these areas, particularly because of their extremely low valuations. Now, many people have said that value stocks have been value traps for a long time, and indeed that's been true. Underlying fundamentals have been weak for many areas like banks and resources. And also, of course, ever lower interest rates have been more beneficial for long duration growth stocks. But a lot of the value areas, like the banks, like the resources and energy stocks, had until very recently actually reached lower relative multiples in markets than they had even in the worst part of the financial crisis. It's interesting that, year to date, the best performing sector in Europe, I think, has been banks, and in the US, both banks and energy. And that's a big change from what we've seen previously. I don't think it's negative for tech stocks, but I think there is more room for this shift to a bit more of a value bias as higher rates are increasingly priced in.
So, Peter, given what you've just said, how constructive would you be on banks from now on? And are there other sector-based inflation hedges that you like?
Yeah, I would say a couple of things. First of all, we still like banks in Europe in particular. And again, it's been a very long time since banks have been a good performer in Europe. But obviously, they do benefit from some steepening yield curves, some possibility of higher net interest payments, and also, strong demand coming through after pent-up savings have unleashed some further demand as time goes on. We think there's reasonably good upside there. Equally, we've really liked the resources and energy parts of the market. They've also been very unloved for a long time for lots of obvious reasons, but these are extremely cash generative, very high free cash flow yields. They've got strong balance sheets, and some of that money will go back to shareholders. And thirdly, and related to that, in an asset allocation perspective, we've been long of equities and other real assets like commodities. Our commodity analysts are really quite bullish structurally of many commodity prices. They've been calling for WTI oil prices reaching 90 by the end of this year. And then there's also some strong underlying secular supports for some commodities like copper as we move increasingly towards electrification, which is going to require more copper over time. So the benefits of commodities, that they are naturally some kind of inflation hedge along with equities, because their yield will tend to rise with inflation over time, their dividends, sorry. And so those are the areas that we're really sort of reflecting on in our asset allocation, where we remain underweight in bonds.
But Peter, in value, the value over growth story has been touted for months, if not years. How comfortable are you that this is really, the time to get into that trade?
Well, I think we need to, Francine, distinguish between sort of tactical cyclical opportunities and structural secular stories. We've been arguing for a rotation based on this likely inflection towards higher inflation expectations and bond yields. But I don't think this is the start of a multi-year shift in the leadership of factors in the market to, value significantly outperforming growth. In fact, we believe that index returns are going to be harder to come by as we move forwards in time. Remember, we're starting the cycle with very high valuations, record low interest rates, very high margins and profitability. That all spells less beta, less index returns, and really much more alpha. And I think the real dominance and focus on factors in the last decade, growth versus value, defensives versus cyclicals, is going to gradually weaken, and people will look much more at alpha opportunities across and within sectors, and indeed across regions. So we think it's going to be much more about stock picking.
Peter, we also spoke to the Hong Kong chief executive, Carrie Lam, and she raised her concern with resuming normal travel in an exclusive conversation with Bloomberg. First of all, let's listen in.
Of course, I am concerned, and we are working very hard to resume normal travel in a gradual and orderly manner, both with the mainland of China and with overseas places.
So, Peter, I mean, this, of course, goes back to some of the travel stocks, some of the challenges there, but it also goes back to what you do with investments in China right now.
Yeah, I think on the travel side, clearly this is one important element to the potential pickup in services. Remember, what we've been seeing in recent months is high savings that have been accumulated during the pandemic being unleashed in strong demand for goods, hitting a point where the supply of those goods is relatively limited. Services have still been held back, partly because of the continuation of the Delta variant. But we think that you should start to see some improvement in services as travel opens up, people get more confident to go out and to enjoy services and entertainment. So I think that handoff is probably what we should be expecting over the next several months. In terms of China itself, our strategists who cover that region are quite optimistic. You know, we've seen a really big derating. Understandably, given the higher risk premium associated with many stocks in that market, given sort of changed direction from the government, more uncertainty about future growth. But while the economy there is slowing, the market offers really reasonably good value. And again, selectively, we think there's some interesting opportunities there.
Peter, thanks so much. Peter Oppenheimer, their Chief Global Equity Strategist at Goldman Sachs, stays with us. Coming up, we'll talk about the Bank of England with Peter Oppenheimer. Two Bank of England officials have reinforced signals that a hike in UK rates may be imminent as authorities seek to quell inflation pressures. We also continue our conversation, of course, with Peter Oppenheimer from Goldman Sachs. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. So two Bank of England officials are moving the policy dial. Michael Saunders and Governor Andrew Bailey have doubled down on the possibility of an imminent rate hike amid rising inflation risks. Well, to dive a little deeper into this, let's get straight to Lizzie. So Lizzie, it looks like actually December looking like a realistic bet.
Yeah, so over the weekend we heard from the Governor Andrew Bailey warning of a potentially very damaging period of inflation unless policymakers take action. And then we heard from Michael Saunders, who we know is one of the more hawkish members of the Monetary Policy Committee. Remember, he voted to end the current asset purchasing programme early last month. And he said that investors were right to bring forward bets on rate hikes. So at the very least, this makes clear that the Bank of England's next meeting in November will be very much live. Both members appear to be laying the communications groundwork for a rate hike decision soon. Economist Liz Martins at HSBC said Saunders could vote for a rate hike in December or even November, and he might not be the only one. So in short, yes, they're signalling that December is a realistic bet.
Lizzie, thank you so much. Our economics reporter there, Lizzie Burden, with some of the things that we've heard over the last 2 to 3 days. So let's get back to Peter Oppenheimer. He is global equity strategist at Goldman Sachs. Peter, when you look at the UK, there was a belief as we got into the year that we could see a UK equity rally. Given everything we've seen, is the UK now a basket case?
No, I don't think it is. I mean, of course, there are counterbalancing factors here. It looks as if the UK might be one of the first of the major central banks to raise rates, as you've just been describing, and we do think that rates will be rising by about 1% to about 1% by the end of 2023. Obviously, the UK has also been heavily hit by supply constraints, and the economy has slowed, as we've seen elsewhere, and that combination is difficult. But it is a value index. It trades at well over a 30%, nearly 40% discount, for example, to the S&P, one of the biggest discounts we've ever had. And it does have quite a large composition of value-orientated names, including resources and energy and banks, which for many reasons, legitimate reasons, have been very unloved for some time, but could benefit a little bit more from this higher inflation, higher interest rate type of environment, as we were discussing there before the break. So I think there are pockets of the UK market that will look more attractive as we move forwards in time. And banks are a good example of that.
So, Peter, I was going to ask actually what you buy in the UK right now. We also have noise about the, Irish protocol. We don't know 100%, what happens with that, or clearinghouses come June 2022. So what do you see as attractive right now?
Well, I think within the market, there's a couple of things. In the FTSE 100, the big areas like banks and resources, we like. The oil stocks are very cash generative. We think the dividends are sustainable and can grow over time as oil prices continue to rise. Basic resources as well, particularly those that have high sensitivity to things like copper. But banks too, banks are very cheap. They're trading at around a 30% discount to the UK market. That's in around the 6th percentile of its historical experience at around a 7.5 times forward PE. And these companies, again, are very, very sensitive to rising rates. And, they've got a lot of retail deposits and will be big beneficiaries of that. So I think there's a lot of value in there that can be extracted as well. Bear in mind, we have seen already quite a big rise in bond yields. They've gone up 80 basis points year to date. That's more than we've seen across the euro area in the US. And we've seen about 20 basis point rise just in the last 10 days. So the things that will benefit from that steepening yield curve or higher rates, I think are obviously interesting. The other thing that's been very depressed, of course, is more domestic service-orientated parts of the market. Those are being suppressed for obvious reasons right now. But again, as this pandemic hopefully moderates and you get further eases over travel and mobility, I think there's some areas there that could catch up as well.
Peter, is the Bank of England actually if they're the first one to start hiking rates, does it put more pressure on other central banks to actually start at least communicating, not on taper, but on interest rate hikes? Or is it because it's a small open economy, given what we've seen with Brexit and, of course, also the lack of drivers, it's different, so it won't really influence other policymakers?
Well, I think in reality, a lot of these pressures that we're seeing, are similar in form in other parts of the world also, maybe to varying degrees, and the timing might be a little bit different. But, we are moving into a phase where all of the main central banks are beginning to guide towards the end of this sort of emergency support, whether that takes the form of moderating asset purchases or potentially moving to higher rates. And that will happen in various times. I think the direction is still rather similar, and the supply constraints that we're seeing in the UK, while they're very acute, are not unique to the UK itself. So I think what we need to consider here is that we are moving into a period where interest rates, monetary policy is going to be less supportive as we move forward, and fiscal policy too. And again, we need to put this in context. If you look at global interest rates, they are the lowest levels they've ever been. Looking at data going back not just over a few decades, but a few centuries, it's not sustainable for them to remain at these levels if you are getting some gradual move higher in inflation. In the interim, though, negative real rates are still quite supportive for real assets. It's going to be the balance between the speed and the timing of rate rises and what happens to growth, and that underlying support of negative real rates, which I think is going to be crucial to determining what happens in markets. But overall, we would expect now lower returns across financial assets, bonds, credit, equities, than we've seen in recent years, and much more focus on selection within these different markets between relative winners and losers. And we think those opportunities will still be quite attractive for investors.
Peter, thank you so much for all of your insight today. Peter Oppenheimer, their Chief Global Equity Strategist at Goldman Sachs and author of The Long Goodbye. Well, coming up in the rest of the program, Carrie Lam tells Bloomberg exclusively that she will keep curbs on movement in Hong Kong as she's duty-bound to protect the city. More on that shortly. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg. First word news. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Poland's nationalist leaders have slammed opponents for spreading fake news at anti-government protests over the weekend. Opposition leader Donald Tusk accused the ruling party of trying to withdraw Poland from the EU in a demonstration in Warsaw attended by as many as 100,000 people. The country's prime minister denies he's planning to pull out of the European Union. Sydney is emerging from more than 3 months of lockdown, with restaurants, gyms and retailers allowed to open to fully vaccinated customers. The state of New South Wales had been one of the world's most prominent success stories in containing COVID before it introduced strict stay-at-home orders to fight an outbreak of the Delta variant in June. I'm Leanne Gerrans. This is Bloomberg.
Well, Goldman Sachs cuts its U.S. growth forecast. Bank cites a lagging recovery in consumer spending. Goldman's Peter Oppenheimer tells this program the stagflationary narrative has started to dominate the markets. Bank of England officials send more hints of a looming rate hike. The governor, Andrew Bailey, warns of a potentially very damaging inflation. And Hong Kong Chief Executive Carrie Lam defends the city's status as a global financial hub. More of our exclusive interview this hour. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So this is what the market's looking at. Again, the market's kind of trying to figure out the week that will be. A lot of the focus is on the energy crisis, and a lot of the focus will be on exactly what we'll see, for example, for the price of oil. Surging above $81, it's a psychological level. We haven't seen crude rising past $80 a barrel since 2014. If you look at some of the equities here in Europe, look, they're declining, led by travel and property firms. And then I'm also looking at some of the U.S. futures down as well. Iron ore, we're expecting more demand because of some of the things that are happening in China, gaining 9%. Now, soaring food prices and labor shortages are threatening the restaurant industry's fragile post-pandemic recovery. Diners may be back, but the energy crisis is rippling through food supply chains and eating into profitability. Well, we're now joined by the founder and former chief executive of AmRest, Henry McGovern. Henry bought fast food brands like KFC, Burger King, and Pizza Hut to Eastern Europe in the early 90s. AmRest currently operates over 2,000 restaurant franchises globally. So, Henry, thank you so much for joining us. 2021 is a difficult day, actually. It's a difficult year for a lot of businesses around the world. How do you look at the energy crisis and the impact this could have on franchises and restaurants?
First of all, it's a pleasure to be here. Thanks for having me on. The whole cost structure of restaurants is all about how do you build the brand and can you pass those on to consumers. Energy can be a big piece of different brands, up to 4% of the P&L. Labor is definitely tight. We see in brands that stayed open and kept a relationship with their customers during COVID doing much better on the labor side than those that closed for a long period of time and those team members went somewhere else. So it's a pretty dynamic time in the restaurant space, and certainly the best brands that stayed open and served are doing the best job at the moment.
Henry, what does it mean for, how will we actually consume in restaurants and, eat differently because of the pandemic? Has it changed everything, or do you think it just accelerates some of the trends that we've seen in the past?
Mainly it accelerated the trends on delivery and digital, of course, but there's some pretty dramatic charts when you look at the industry. Overall sales were dramatically down in 2020, and then it's depended on the waves that have come through different countries and what their rules have been about serving up the business customers and where you've been. I mean, you look in the UK where so much was dependent on the city or travel, and those were the high flyers, and now they're gone. And you look at what's happened with home delivery and being out in the neighborhoods, and those are flying. So the business really is dependent on what sector you're in. Obviously, coffee is highly dependent on travel and downtown business, and that's been disrupted. But pizza and burgers, two areas that were always strong, got even stronger. Delivery's here. Delivery is going to continue. You've heard a lot about dark kitchens. Those are kitchens that are serving just delivery without a storefront. those continue to grow. But I think that you can see other brands like Gales. We just invested in Gales along with Bain Capital. And Gales in the UK saw extraordinary growth over the last 2 years. And that's because they served the neighborhood and they were part of it. And it was not driven by delivery or digital. It was driven by being part of the community. So I really think it depends on where you're positioned. Obviously, there's some, if you're in, the travel, leisure, or if you're in the catering business, that's been super difficult over the last couple of years. And I think as we see slow go back to work, that's going to continue to be difficult.
I have to say, Gales is pretty extraordinary, Henry, also because you can buy the loaves of bread in the major supermarkets. So is there anything else that you think could become as attractive as Gales? You have to keep, I guess, a local feel whilst at the same time make sure that you expand enough.
Yeah, another acquisition we did was Vapiano. Had to be probably the first acquisition during the pandemic. We bought it in May of 2020 out of some very difficult times as people were unsure. But again, that was a category that we were pretty sure was going to come back. You had a bit of social distancing because of the size of locations. Pizza delivers extremely well. So we're pretty excited about the portfolio we're building. But the main thing we're getting into now is trying to evolve this supply chain. We believe the supply chain is broken. As you hear, I'm American by background, but I moved over to Europe after the fall of the wall to see what the changes were going to be in Central Europe. And because there was so little there, we got involved in all of the development of everything from our chicken suppliers to cheese suppliers. We had to fund our tortilla suppliers. But what we noticed over the 25 years is really the supply chain and the production system is broken. And we're very excited about what's happening with food technology and the food tech side, the development of cell cultured proteins, fermented proteins. We think that that's going to shift and enhance the food supply system and the food quality globally over the next 10 years.
So, Henry, how much do you, I don't know how you look at or how you view the UK, whether it's, a good testing ground because a lot more people are online and, for example, shop online. So there's a good testing ground for restaurants to then export to the rest of Europe, or given the supply chain issues also linked to Brexit, does it become just a lot more complicated?
I think it becomes more complicated. Crossing borders is tough. Consumers are different everywhere. It always shocked us. I think anybody who's been in this industry will tell you that crossing borders is usually where they have the most scars on their back. And it's hard to understand why each country has its own individual taste profiles, its peculiarities of what becomes an iconic brand. And so you have an affinity towards it, and there you have this customer affection. We see that challenging sort of across whatever segment, whether you're talking about the fast QSR business or whether you're talking about iconic, fine dining restaurants that get known for a city. It's just hard to cross borders. I think the digital piece is making it easier. It's building brands. It's allowing brands to test things more simply in new countries and iterate more quickly. So it's helping, but I don't think the UK has a particular advantage in that versus any other country.
Is there something new? I don't know whether there's anything left to be disrupted, actually, whether if you're looking at something which is the way we deliver. I know we use Deliveroo or Just Eat here in the UK, and then now there are, 3 or 4 at least other competitors that maybe focus on higher end food. Like, how do you see that space?
Yeah, it's changing very quickly. If you look at Gitter or Gorillas, two these companies that have sprung up that now deliver in 10 minutes, it's kind of changed our view of what Deliveroo and the rest of the group has been doing for the last 15 years. We're seeing a lot happen on the ready meals side of the industry. Companies in the U.S. like Cook Unity that are preparing meals. They can be chef-driven, they can be dietary-driven to serve very specific needs. And people are starting to buy in large numbers, the full meal plan for the week. So people are starting to step back away from this, oh, wait, I'm hungry, I better order, into, let me think about what I want to eat. Let me think about the quality of what I want to eat. Is there a dietary need I need to meet? And they're starting to plan out. And I think that's going to shift because it reduces the heavy cost of delivery that sits on any of these platforms because it enables people to deliver, 3 days worth of meals or a week's worth of meals. And so these ready meal programs, I think, are here to stay and take market share over the next few years.
Henry, when you look at the field that will still be left open, how much do you worry about inflationary pressures and having to pass that consumer or that price increase onto the consumer?
Yeah, it's a big issue. We're seeing price increases really across everything right now in the P&L. As you mentioned at the beginning of the program, here you've got the whole energy piece, you've got the labor side. The landlord negotiations have obviously been dynamic during COVID, and you see a lot of disruption in the P&L because of this delivery piece we were just talking about, because it has a higher cost structure. So the brands that people will pay for, I think we're going to see a decline in your mom and pops, your one-off restaurants, because it's hard to maintain, the competitive. You just don't have any scale in the industry, and so you need scale. We're big believers in building brands and scale. That's what we think stands up to any hard time, and it also is able to thrive during the good times. So we're a believer that this will pass through. The industry is here to stay. People want to be out of the kitchen. It's a trend that's been going on for 25 years. I'll tell you an interesting stat on the industry. Europe for 22 years has tracked the top 99 brands in Europe, and every single year they have taken market share. So you see that brands continue to take market share at all levels of this industry, and I think that's going to continue for all the reasons that we talked about: just efficiency, environmental impact, the whole ESG piece. I think they're more efficient. They're able to withstand these issues. So I think we're in for a tough couple of years, but then you're going to see, like every cycle, you're going to see a situation where too many people have moved out of the business, and it's going to be the boom times again. So we're just in a tough, sort of adjustment cycle, but this is going to play through because eating out is just a huge part of everybody's life.
Henry, thank you so much for all of the insight. Henry McGovern, their founder and former CEO of AmRest, joining us this morning. Now, we're also getting a little bit of breaking news from the Qatar Oil Minister. This is on a number of things. First of all, remember, Qatar also has the FIFA World Cup in 2022, which is why it's probably significant that they said a net zero emission pledge would not be right. That's quite significant because they had said just a couple of months ago that they were on track to meet the carbon neutral commitments. So maybe they're on track to meet some of the commitments, but they don't want to do a net zero emission pledge outright. The energy minister also saying they're unhappy with gas prices because they're too high at the moment, and confirming that they will also not rejoin OPEC. Now, coming up, duty-bound, Carrie Lam defends COVID curbs in Hong Kong, even as Singapore starts to reopen. So more from our interview shortly. This is Bloomberg.
Taking emotion out of it completely, staying educated, very, very important, staying disciplined, right, and staying patient, especially in an environment like this where we have volatility, like unbelievable intraday.
There's a psychology around understanding what's out there, not fighting the market, and being respectful of the market and what the market's telling you, and being really cynical about every input that's in your mind, and questioning every assumption, which can be tiring sometimes. But you have to do it.
I think it takes discipline and sort of ability to disentangle, and I know that sounds weird, but sort of disentangle the decision-making process from the day-to-day.
I think having that early sort of insane volatility of crypto has, helped me manage volatility and understand that I could always be off by an order of magnitude, and so to plan for that.
Well, you take all crypto, all tokenization, all DeFi, everything related has gone to $2 trillion. So everything that we do day to day that people don't even realize yet, that market's telling you is going to be disrupted.
There's an opportunity when there's lots of excess volume, and we've seen that with a lot of these meme stocks. The retail engagement, by the way, the retail engagement from my perspective is unbelievably good for us. All right? I am a big fan of growing our ecosystem.
Well, traders around the world are speaking to Bloomberg about how they've had to adapt over the course of the pandemic, and you can read more from them today in today's Big Take, a story across the Bloomberg platforms on the terminal at NI Big Take Go. Now, the Hong Kong chief executive Carrie Lam has also defended COVID-19 travel restrictions that are frustrating global businesses, signaling curbs will stay in place for the foreseeable future. Well, she spoke exclusively with Bloomberg TV.
From the mainland perspective, is the practices adopted in Hong Kong should be as aligned as possible with the mainland practices. But they also accepted that we are operating under a very different regime. So the discussions between the two sides are meant to find a way forward that respecting the differences in the systems between the two places, that there could be assurance that we will not be sort of the weak link in terms of COVID-19 control.
For Hong Kong to remain a international financial hub, it has to be open not just to China, but the rest of the world. Are you concerned perhaps that your competitiveness will be impacted? Because Singapore is opening up and there's great competition between the two cities. Might Hong Kong lose its competitiveness?
Of course, I am concerned, and we are working very hard to resume normal travel in a gradual and orderly manner, both with the mainland of China and with overseas places. But as a chief executive in Hong Kong, I am also duty-bound to protect my people. So any fatality or increase in fatality will cause a major concern in society. So in dealing with the public health crisis, we have a lot of factors to take into account. It could not be just a single factor of a financial center. But coming back to financial center, I think Bloomberg knows better than everybody that we are doing very well.
A wall of worries for international investors, among them the Anti-Sanctions Law. Lots of speculation. It's been delayed, whether or not it is on the back burner or whether or not it is dead. Talk to us about what's happening with the Anti-Sanctions Law.
Now, first of all, the Anti-Sanctions Law is a piece of national legislation. So there is a mechanism for national legislation to be applied to Hong Kong by an act of inclusion into the Annex 3 to the Basic Law by the National People's Congress Standing Committee. Secondly is nobody could dispute the extension of this law to Hong Kong if needed, because this whole round of sanctions by the United States arose out of Hong Kong. I am a sanctioned officer. I'm still an officer being sanctioned. So the time will come that if Hong Kong is put in that sort of situation, then of course we will follow the central authorities' direction to implement any anti-sanctions measures. The most important point is I have been given to understand that the anti-sanctions law at the national level is a toolbox. And in extending a toolbox to the Hong Kong Special Administrative Region, the central government will take full account of Hong Kong's unique status, especially her status as an international financial center. So the final point is I have no timetable.
Well, Hong Kong's chief executive Carrie Lam there speaking with Bloomberg's Hasleen Amin. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Nick Byton is to step down after 12 years as chief executive of ASOS. This is a UK online clothing retailer reported profit of £177 million in the latest year, below analyst forecasts. The company says it's confident of the opportunities ahead, but is also warning of global supply chain and cost pressures. Now, French grocer Auchan is said to have made a recent approach to acquire a rival Carrefour. Sources say the deal would have valued Carrefour at about €16.6 billion. However, talks stalled because Carrefour management and key shareholders thought that offer was too low. We are told it's unclear if negotiations will be revived. Nissan will spend more than $1.2 billion on technology upgrades to make its global factories greener and ready to produce EVs. It has spent the last 2 years revamping its plant north of Tokyo, adding VR training systems and automating parts of production. Other Nissan factories in Japan and the US will now get a similar treatment. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, coming up, the market starts to price in a 25 basis point hike from the Bank of England by the end of this year. Andrew Bailey says it's not just wishful thinking. More on that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So, as we were saying before, also with Peter Oppenheimer, 2 Bank of England officials are moving the policy dial. Michael Saunders and Governor Andrew Bailey have doubled down on the possibility of an imminent rate hike amid rising inflation risks. So, let's get straight to Lizzie Burden. So, Lizzie, we're talking before about December looking like a realistic bet, but what happens if it's in November?
Well, if it happens in November, you've got the risk that there could be a spike in unemployment still from the end of the furlough scheme. And the Bank of England's really taking the risk that that isn't going to happen. Over the weekend, we heard from the Governor, Andrew Bailey, and Michael Saunders. And Bailey said that he doesn't expect this spike in unemployment. Back in the September minutes of the meeting, officials had said that a rate hike was possible this year, but they were waiting for clearer data on the labour market. And we knew that we wouldn't get data until at least December, and even then it would be volatile and lagging. Andrew Bailey said he doesn't expect that spike. So not only does what Bailey and Saunders have said make the December decision live, but it implies that the MPC is putting more weight on inflation because of the rise in energy prices, because of the supply chain disruptions. But the risk is that the Bank of England chokes off the recovery prematurely at a time when growth is weakening and the government's already trying to rein in the public finances.
Lizzie, thank you so much. Bloomberg's economics reporter there, Lizzie Burden. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin with Kailey Leinz in New York. Now, we have a packed week ahead. I think there's quite a lot going on when it comes to the oil price. Of course, it's $80 a barrel, so we'll have a plenty more on that. This is what else we're looking at. So let me talk you through the markets. And actually, stocks are dropping, oil surging. This seems to be unsettling traders. If you look at fuel shortages in China and Europe, they really bolster the case that higher inflation will persist beyond the expectations of central bankers, and that seems to be pushing them towards faster rate increases to redress price pressures. This is Bloomberg.
The Fed's given us all the information we need.
The Fed wants to see more inflation surprises, more inflation overshoots. And I think in a stagflationary environment, they're going to tolerate that higher degree of inflation.
It's all about the hikes. I think the market now has essentially priced in the start.
We know 2022 might be more complicated than 2021 from a growth perspective.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
It's 10 a.m. here in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Monday, October 11th. Our top stories today. Goldman Sachs sees a speed bump in the recovery while the firm cuts its forecast for U.S. growth and blames a delayed recovery in consumer spending. A warning from the Bank of England officials, an interest rate hike may be imminent in order to fight inflation. And Hong Kong's chief executive defends her COVID restrictions. Carrie Lam tells Bloomberg in an exclusive interview that the city cannot become a weak link for infections. Well, good morning, everyone. Happy Monday. We have Matt Miller. He's back. And Kailey, quite a lot going on in the markets. We look at WTI above $80 a barrel. That's psychological.
Yeah, absolutely, and feeds into the inflationary fears that are percolating really across the world. That said, didn't weigh too much on risk sentiment in Asia, where stocks were broadly higher. A lot of green on the screen at GMM Go. When it comes to the equity markets, you did have bonds and currencies down in Asia. But as far as the equity markets go, China was your relative laggard, only up about 0.1% on the CSI 300, while stocks rose more than 1.5% in Japan and 2 percentage points in Hong Kong. And that move in Hong Kong was really led by technology. The Hang Seng Tech Index rising more than 3% after China gave a smaller than expected antitrust fine to Meituan, of course, the ride-hailing company. That eases some regulatory fears, and Meituan shares, for their part, up more than 8% in the overnight session. In other asset classes, I would point to coal futures in China, because already, obviously, they were dealing with a power crunch, and now there is flooding that has shut 60 mines in its main coal-producing region. So that really just exacerbating the problem. Coal futures at a record high. And then I would just point to the yen, the big underperformer in both G10 and Asia. It is at its weakest against the dollar, going all the way back to December of 2018, right now trading at 112.91. Now, here in the U.S., as Francine said, the big news over the weekend was Goldman Sachs cutting its growth forecast for the U.S. economy for both this year and next. But at the same time, you have Goldman Sachs chief U.S. equity strategist David Kostin saying stocks will ease up on their inflation fears and continue to power on. They are not, however, powering on this morning, with futures down on S&P E-minis by about 0.25%. You are, of course, on the Columbus Day holiday here in the U.S., so even though equity markets will be open, cash treasury trading will not happen today. Futures, though, for treasuries are in negative territory. The dollar is essentially flat, just slightly stronger on the day. And then, of course, oil is the main story, up 2.8% on WTI. We're north of $81 a barrel, Matt, right now at 81.56.
Yeah, really interesting stuff, I think, going on in markets today. Take a look at what's going on in Europe. This just adds, I think, to the story, because we've got markets that are down on the continent, but the UK is gaining. That's because the UK FTSE benchmark index is very heavy with energy producers, very heavy with metals and miners. And since commodity prices are so high, the FTSE is doing better than indexes in the rest of Europe. Now, that's doubly interesting because the pound is actually gaining against the dollar. The greenback, as Kailey just showed you, up against most other currencies, and the euro, in fact, is down against the dollar. But the pound is up as speculation about the direction of rates from the Bank of England is on the high side. And it's rare that you see the pound rising and the FTSE rising. Typically, there's an inverse correlation there, Francine. So I think it's really interesting to watch what's going on in Europe this morning.
Yeah, 100%. At least 15 basis points of tightening for the Bank of England actually priced in by December. So there's a huge, huge swing in market expectations. Now, look at what else is coming up this week. More Fed speak on tap, with Chicago Fed's Evans kicking off things today. Plus, the IMF and the World Bank annual meetings start in Washington. A lot of the focus, of course, is on the IMF chief's fate. A slew of bank earnings throughout the week. JPMorgan leads the parade on Wednesday. And finally, U.S. CPI data is also due out on Wednesday. So as Matt was saying, two Bank of England officials are moving the policy dial. Michael Saunders and Governor Andrew Bailey have doubled down on the possibility of an imminent rate hike amid rising inflation risks. Well, Therese Raphael, Bloomberg opinion editor, joins us now. Therese, I mean, it does seem like the market is now expecting a rate hike as soon as November or December. What does that mean for the economy?
Yeah, well, it's these rate hikes are normally telegraphed a little bit sooner, and so I think there are a few issues that this one raises, and one is a communications issue. It's come quite suddenly. You also have it coming at a time when the bank is still, there's still quantitative easing going on, right? That's not supposed to end until mid-December. So it's a bit awkward to be raising rates and doing QE at the same time. It sort of sends a mixed message. But, the real question is, what problem are they trying to solve? Because the inflationary, one is inflationary expectations, which, are baked in on all sorts of fronts. But these are not simply domestic pressures. So it would be one thing if you had domestic inflationary expectations rising because of a hot economy. But, people are paying more for gas prices. They're not necessarily using more gas or electricity. A lot of these pressures are coming externally.
Well, and paying more for gasoline, for petrol, if they can get it. I saw a video over the weekend of someone riding a horse past a gas station petrol lineup. What's the story in terms of Brexit and the clash right now as we head to a decision on Northern Ireland?
Well, it's interesting that the standoff with the EU always seems to come to a head when there are other things going on that would be very convenient for the government to distract people's attention from. And that certainly seems the case now. So we have Lord Frost going to give a speech on Tuesday. He's going to demand that not only does the EU relax the Northern Ireland protocol so that there can be easier trade between Northern Ireland and Great Britain, but that the European Court of Justice no longer play a role in adjudicating what is consistent or not consistent with EU law. That's obviously a red line for the EU. So this is setting up yet another clash. And, the question is, where does it end right now? Because right now we have trade competition between the two. We have a war of words. But, what does a trade war look like if that's where it's going?
Therese, thank you so much. Therese Raphael there of Bloomberg Opinion. Now, Hong Kong Chief Executive Carrie Lam has defended the city's tough border restrictions, signaling the curbs will stay in place for the foreseeable future. Well, she spoke exclusively to Bloomberg.
Of course, I am concerned, and we are working very hard to resume normal travel in a gradual and orderly manner, both with the mainland of China and with overseas places.
Let's get straight to Tom McKenzie for the very latest. Tom, how awkward is this actually for Hong Kong in saying, well, Singapore is opening up, but we just don't want to, we need to be careful?
Well, there's a couple of key lines that come out of this. One, of course, is that Carrie Lam, the chief executive of Hong Kong, came out and said, we will not be relaxing these curbs. Number two is she made it very clear as well that she was having to align with Beijing and with mainland China to ensure, as she described it, that Hong Kong doesn't become a weak link. And to your point, it's absolutely central to the business environment in Hong Kong, which is an international hub. It's fine for mainland China to be cut off to some extent, but Hong Kong, of course, has built itself up on being an international hub for business and investors. And the realities are that if you have a vaccine, even if you're vaccinated and you want to return to Hong Kong, you have to, in most cases, quarantine for 3 weeks, 21 days. And there's no sign from this interview with Haslinda Amin that this is going to change. Carrie Lam saying she has to align with mainland policies on this. And also, to your point, that puts them at a disadvantage, arguably, with Singapore, where you had the Prime Minister coming out of the weekend saying we cannot remain closed off and locked down indefinitely.
Yeah, travel restrictions, just one element making doing business in Hong Kong a bit more difficult for international companies. Tom, I also want to ask you about Evergrande, another $150 million in coupon payments on dollar bonds due this week. And it seems contagion or spillover threat seems to be percolating throughout the markets.
It is. To some extent, the focus has shifted away from the plight of Evergrande and to that spread. So you have companies, developers in China like Modern Land, which, for example, has proposed that it delay a bond payment by 3 months. You have Xinyuan Real Estate as well, proposing that they pay just 5% of principal. This was after Fantasia Real Estate. They came out with a surprise default last week. And as you say, of course, Evergrande has not been wrapped up in any shape or form. You have dollar bond payments that are due this week for that company. And so far, it seems at least that the government is continuing to sit back and see just how far this bleeds into the system. They're, of course, going to focus on liquidity conditions, but this is at a point where US dollar high-grade bonds in China are now yielding above 17%. So that spread very much continues.
Absolutely. All right. Thank you so much to Bloomberg's Tom McKenzie. And turning now to Washington, Treasury Secretary Janet Yellen says she expects Congress to follow through on that global tax deal. She told ABC she's confident it will be included in a budget reconciliation package.
I am confident that what we need to do to come into compliance with the minimum tax will be included in a reconciliation package. I hope that it will be passed and we will be able to reassure the world that the United States will do its part.
Emily Wilkins, Bloomberg government reporter, joins us now from Washington. So, Emily, Janet Yellen is hopeful, she's confident, but where are we likely to see pushback come from?
Well, right now, the question is very much within Biden's own Democratic Party. I mean, they are the ones who are working on this reconciliation package. They do not need to worry about Republicans. Republicans certainly might raise some concerns about this tax, but at the end of the day, it's Democrats who are the ones responsible for passing it or not. And I think the main concern is that the fact of the matter is that the 15% minimum global tax rate is still below what the U.S. currently has at 21% and what they're looking to go. Biden proposed 28%. We've heard discussions of 25%. And this is all being worked out in that package of that larger social welfare and tax plan. So this isn't just a matter of the corporate rate, but a number of other social policies that Democrats are trying to figure out whether or not they should include. One thing that's become clear is that everything is going to have to be paid for. If Democrats propose a program that costs $100 million, they're going to have to find $100 million in new revenue to pay for it. And so this is all part of a larger debate that's going on. Democratic leaders have said that they hope to get this package done by October 31st, but it's unclear at this time if they'll be able to meet that deadline.
So, by the way, Emily, very separate from obviously the budget and the debt ceiling issues that you deal with on a daily basis, I'm sure inside the Beltway, everyone's talking about the future of the IMF. What do you hear about Kristalina Georgieva and the International Monetary Fund?
That's definitely something Washington has been paying attention to. You've kind of seen the U.S. and Secretary Yellen distance themselves a little bit from Georgieva while she's been undergoing this investigation. We heard last night the IMF's executive board went late into the night speaking with both Georgieva and the law firm, accusing her of data manipulation. They say that they are hopefully will be able to come to an agreement soon. Remember, big meetings kicking off this week in Washington, as I'm sure many of our viewers are well aware of. And they're hoping that this can be resolved and not sort of cast a shadow over the larger negotiations and discussions this week.
Well, it'll still be a major undercurrent. Thank you so much to Emily Wilkins of Bloomberg Government. And let's get back to the markets now and take a look at some stocks moving in pre-market trading here in the U.S. I want to begin with Southwest, because if you had a Southwest flight booked yesterday, chances were about 1 in 4 that it would ultimately be canceled, because Southwest canceled 28% of its flights scheduled for Sunday due to air traffic and weather issues. As a result, that stock down about 1.8% in pre-market trading. Another downside mover is Robinhood, and this is after a late filing on Friday to regulators saying that regulation around cryptocurrencies and payment for order flow could pose a major threat to its business. As a result, that stock is down about 2 percentage points in early hours. One upside mover to the upside, though, and pretty much any mover to the upside, is going to be in the energy complex. Broad-based strength there as we see oil north of $81 a barrel on WTI. Just one example of that is Occidental Petroleum. Those shares up the better part of 3% before the bell, Francine.
Yeah, it's pretty incredible, actually, this energy crunch really giving a lift to a lot of these oil producers. I was also reminded of Goldman Sachs call WTI at $90 a barrel by year-end. Coming up, Mike Bell, JPMorgan Asset Management Global Market Strategist. We'll talk about Bank of England, we'll talk about inflation and the markets. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua in London and Kailey Leinz in New York. Now, we were just talking about rising energy prices and how that's lifting shares of producers, but it's also a real concern for another commodity, and that is copper. As energy prices force factories to shut down, the price of copper has taken a hit from an all-time record. I have a chart from the Bloomberg terminal here. I'll welcome our listeners on London DAB Digital Radio and just tell you that this chart shows Chinese electricity output falling and a coinciding drop with the price in copper from an all-time record. Eddie Vanderwalt, Bloomberg MLive strategist, joins us now to talk about this trend. Eddie, I thought there was a great story on the Bloomberg this morning about copper bulls getting an electric shock, is how they put it. On the one hand, you could see this as bad. On the other hand, people are saying that the demand hasn't been canceled. It's just been pushed forward and maybe even is like a spring compressed, ready to rebound. What do you see in the future of the price?
Yeah, Matt, I love that headline. I was just emailing Jack Farchi and the other reporter on that, Mark Burton, so congratulating them on that story because it was absolutely the right headline for today. But you know what? There's such a big irony in the commodities markets at the moment. On the one hand, you have, energy prices soaring because the world is going through, at least partially, part of the story is about the decarbonisation, which means that we're going to use more copper. But in the short term, it's a very negative for copper prices, right? Because if we scale back our electricity consumption in the short term, that pushes down copper prices in the medium term. But the long-term outlook for copper, undeniably bullish.
So what does it mean, Eddie, for going, if you look even at the price of oil, so $80 a box, first time in 2014, psychological level, could we see a repricing? I mean, does it just go higher from here?
Right, absolutely. Copper is the absolute flip side of that story, right? Because we see natural gas prices and other energy prices just soaring, you're expecting to see some producers and people who can substitute their energy sources from natural gas to oil. You're expecting them to do so. And at the same time, OPEC still seems quite comfortable with these higher prices. They don't. I personally thought they would pump more into these rallies, but that hasn't been the case. And therefore, the bullish case for oil in the near term certainly is very strong.
And obviously, the higher commodity prices for oil and others, Eddie, is feeding into inflationary or stagflationary fears in this market. And yet you have the likes of Goldman Sachs today saying that equity investors will put those fears aside and will continue to see stocks rallying on. Do you agree with that?
Yeah, buy the dip has been the mantra, and there's no reason to see why equity investors will change that in the near term. But at the same time, as you say, the stagflationary worries, because remember, commodity price inflation is not something that central bankers can easily control. It's not easy to say, okay, I'm just going to raise interest rates, and therefore, the inflation is going to go away because it's coming from higher, raw material prices. And no matter where they put rates, UK natural gas storage is not going to fill up magically. So this is a really hard conundrum for the central bankers. It's not the kind of inflation that they would like to see.
Yeah, it certainly isn't. Thank you, Eddie van der Veld there from our Bloomberg MLive team. And you can, of course, follow Eddie and all of his team with more market analysis. Just check out MLive Go on your Bloomberg terminal. We'll have plenty more on the markets. We'll have plenty more on inflation. Great story, of course, looking at gilts, given what we're seeing also with the Bank of England pricing expectations. This is Bloomberg. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. Now let's get straight to the Bloomberg. First word news, and the U.S. has arrested a Navy Department employee and his wife for allegedly selling secrets on nuclear-powered submarines. Now, according to the Justice Department, the buyer was an FBI agent posing as a foreign official. Authorities say the case involved cryptocurrency payments and a memory card hidden in a peanut butter sandwich. Now in Poland, nationalist leaders slammed the opposition after the biggest anti-government protest this year. At a demonstration in Warsaw, opposition leader Donald Tusk accused the ruling party of trying to take Poland out of the European Union. The government called that fake news. And the new James Bond movie opened as the #1 film in North American theaters. Still, No Time to Die fell short of the pandemic-era opening record set last week. The movie took in an estimated $56 million at the box office, not as strong as some were predicting. And Matt Miller has not seen it yet, which really is the breaking news that everybody needs to know. How come?
Well, I was tricked. So over the weekend, my wife said, we got a babysitter, we can go to a movie, but the only thing in the theaters is Dune, because she has a thing for Timothée Chalamet or whatever.
Chalamet.
And I believed
As does
her
everyone.
without checking. I forgot the most important rule. I think Ronald Reagan, trust but verify. I did not verify, and I ended up seeing Dune instead.
Well, if it makes you feel better, Matt,
You
I
haven't
haven't
seen
seen it either.
Yeah,
But
no
you
one's
don't
seen it, but I
care
heard
as
actually it's
much.
amazing.
I love
Yeah,
James
I
Bond.
can't wait. I think, my opinion,
can't
Sean Connery is not the best James Bond ever. I know, Fran, you think the old man did it better. For me, Daniel Craig trumps everyone, including Roger Moore. Yeah.
Matt Miller, the old man, we cannot call Sir Sean Connery the old man, but I do think there is one original, and then this one is second best. Kailey?
Well, and the question is, I'm not going to wade into your argument there. I just am focused on who the next James Bond is going to be, because we still don't have answers. We should put out a poll on Twitter. Everybody take a vote.
Guy Johnson. I think it should be Guy Johnson.
Perfect. And then you can be his sidekick, Matt Miller. Coming up next, we talk about the markets. We also maybe discuss film releases with Mike Bell, JPMorgan Asset Management Global Market Strategist. This is Bloomberg. This is Bloomberg Surveillance, early edition of Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. A lot of the focus, Matt, away from James Bond, which I know we'll spend a lot of time this hour talking about, is WTI above $80, and it's kind of repricing a lot of the assets.
Yeah, and I think it's a huge part of today's market story, not just for WTI or for the energy producers that are rising in terms of their equity prices, but also in terms of the inflation story. You know, is it transient? Obviously, energy prices are taken out of the headline number for the core, but they still have knock-on effects on other prices. And of course, most people need to pay for energy to live life itself. In fact, businesses, that makes up a huge part of their expenses as well. So the question is, you know, how long does this persist, and how long can central banks resist the urge to lift off the accelerator?
Yeah, the million-dollar question, and you can see that being played out in the markets, Kailey.
Yeah, of course you can, Francine. It's interesting. We are looking at losses in Europe, but to Matt's point, the only real sectors in the Stock 600 that are positive on the day are basic resources and energy, benefiting from those higher commodity prices. The index as a whole, though, is down about 0.25% at this point. And here in the U.S., futures also are in negative territory. We're down about 0.3% on S&P E-minis. Of course, the U.S. Treasury cash trading market is closed today for the Columbus Day holiday, but I would point to bond yields on the other side of the Atlantic, specifically the UK, because you are starting to see a repricing of expectations for when the BOE will put into place its first rate hike. As a result, gilt yields are up 4 basis points on the 10-year. It is at its highest going back to May of 2019, sitting at 119.9. And then also going back to the oil and energy story you were just discussing, WTI crude up 2.4%. We are north of $81 a barrel this morning. And as Matt alluded to, that is benefiting some energy producers in pre-market trading. The Energy Select Sector Spider ETF, which gives us an idea as how the sector as a whole will perform come the opening bell, is up about 1.6% in pre-market trading, and a number of E&P companies in particular moving to the upside. Occidental, Apache, Devon Energy, all higher to the tune of about 2.25% to 3%, Francine.
Kailey, a lot going on, of course, in the market, so let's get more on that with Mike Bell. He is Global Market Strategist at JPMorgan Asset Management. Mike, great to have you and in the studio. The value over growth story has been touted for months, if not years, frankly. Is this finally the moment for value to try and outperform? And if it is, what do you buy in value?
Yeah, so we feel that certainly by the end of next year, we think bond yields are still going to move higher than where they are now. And what we've seen really over the last couple of years is that value's been underperforming when bond yields go down and outperforming when bond yields go up. Now, look, winter could perhaps interrupt that story a little bit. We don't know exactly what's going to happen with COVID. So I think over the next 3 months, it's hard to say. But on a 12-month view, we think bond yields will go higher. That will mean financials in particular outperform, and with that value.
I was going to ask you actually about banks, because there's a belief that actually best haven against some of these inflationary pressures as yield curve steepen is banks. Or at what point do they become too expensive?
Well, I don't think they are. Certainly when we look in the UK, banks look pretty cheap, and there's potential for rates to go up a bit faster than the market's currently pricing over the medium term. I think in the US as well, though, banks are more expensive than they are here in the UK, but I think that's justified. And ultimately, if the Fed put rates up in line with their dots, then they're going to be going up faster than the market's currently pricing. And so I think over the next couple of years, banks should be able to outperform.
Yeah, the KBW index of U.S. banks is up like 40% year to date, and that's obviously more than double what we've seen on the S&P 500. So they've had a pretty good run, but rising rates are good news for bank stocks. How high do you think we could see rates go?
I actually think that what the Fed are saying now in their dots is basically what's likely to happen. So the market's moved a fair way to pricing that in for the next couple of years. But when you look out to the sort of end of 2024, the market's still a bit behind where the Fed are saying rates are likely to be. So I think it may take some time. We've seen a pretty big move up in bond yields over the last couple of months. But I think over the next 12 to 18 months, we'll see bond yields move up, probably at a slower pace than they have been, as the market starts to price in that faster pace of rate hikes through 2024.
When you talk about value, Mike, I mean, over even my short 20-year career here, you know, the definition has changed a little bit. What are you thinking about when you talk about value? What does that mean to you exactly?
Yeah, I mean, there's obviously different sectors, but financials really dominate. So it is this rates play. It's a view that if bond yields go higher, then that tends to mean that it's good for the banks, of course, because what that is pricing in higher interest rates in the future, which tends to be positive for the banks. So I think that's the real key story. But it's not just the banks within financials. We're seeing pretty buoyant asset markets, which is positive for things like the asset managers as well.
Well, Mike, let's talk further about the banks. Are they more beholden to the kind of macro story, just the rate environment and the economic environment, than they are when it comes to fundamentals, considering we do have earnings coming up this week?
I mean, ultimately, I think that earnings is going to be the key driver. But when you look at things like the financials, they have the benefit compared with some of the growth stocks, particularly in the US, that the valuation is just at a much lower level. If you look at that gap between the valuation on growth stocks and the valuation on value stocks, it's rarely been as wide as it is today. It's starting to narrow, but we think there's a risk that it'll narrow more. And that may be because the valuation on growth stocks comes down. I'm not necessarily saying the valuation on those financials is going to go up anymore. Even if it just stays where it is, as those higher interest rates come through, then it can help benefit the earnings over the medium term.
Well, speaking of things that are narrowing, let's talk about margins. Given all of the supply chain issues and higher input costs companies are facing, how much do you think that will eat into profits?
So I think it's quite important to be looking at which companies have got pricing power and those which haven't, obviously favoring those that do have the pricing power. For the market as a whole and for the economy as a whole, we're not too worried about it. We're seeing in the surveys that businesses feel pretty confident that they can pass on higher costs to consumers. Remember, of course, that consumers have accumulated enormous amounts of savings over the last 18 months, and so they're in a much stronger position than they normally would be to accept higher prices. And, of course, part of the costs that are going up is wages. So whilst that's a higher wage bill for companies, it's also more money in the pocket of consumers for them to be able to spend.
But Mike, so Goldman Sachs economists are actually saying that they're downgrading U.S. growth because of the consumer. Is it something, I mean, do you feel like this could be happening in the U.S. but not elsewhere in the world? Like, what do you do with the U.K.?
Yeah, I think it's actually quite broad-based, and I do think there's a question mark around the next few months, right? Partly because we don't know whether winter's going to be problematic for COVID, and partly because things like the move higher in energy bills, which is a global story, is at the margin going to shave a little bit off of where growth would otherwise have been. But growth was going to be very, very strong. I think it's now going to be slightly less strong. It's still going to be pretty positive, though, both in the UK and indeed in the US. And I think that's mainly because what we're saying is that some of the money that people have accumulated that they would have been able to go out and spend on something fun, they're going to have to spend on higher energy bills. But you know, to put it into context, if you look in the UK here, we're talking about approximately £140 increase over the next year in energy bills. So that's not tiny, but it should be manageable given that most people have been able to save a fair amount. I think it's the lowest income deciles that are going to struggle the most.
But, well, your take, Mike, is that demand hasn't been destroyed. It's just been pushed back, right? And this is in line with, I think, Goldman Sachs cut a few basis points off of their growth forecast, but said it's going to be made up for in the years ahead of, you know, 2023 and 2024. Nevertheless, it's more difficult to forecast the future, right? So how can you be sure that this demand is going to be pushed back rather than, you know, die an energy death now?
I think the confidence that most people have around the outlook for the consumer just comes back to this point, which seems like an old story now. We've all been talking about it for quite a long time, about the extent to which people have accumulated savings. But when you look at the amount of savings that people have in their savings accounts now, they're still very elevated compared with where they were pre-pandemic. So they've come down a little bit. People have spent some of it. People have invested some of it. But when you actually look in people's accounts, you can see that There's still a lot of savings there, and that exactly when that gets spent is hard to say, but we do feel pretty confident, as I think most of the street does, that over the next few years, that's going to support consumption.
Mike, I just want to quickly ask you on China. Evergrande, for example, has another $150 million worth of dollar bond coupon payments due today. You're seeing contagion really spreading throughout the region. Can you invest in China right now?
So we've done the numbers on this, and ultimately we think that the exposure of the large banks in China to the property developers which are at risk is manageable. It's not going to wipe out the banking system in the way that we saw fears around Lehman Brothers back in 2008. So I think a lot of the talk around a Lehman-type crisis in China is overdone. We think that's very, very unlikely. And ultimately, when we look at China, we see an economy where over the next 15 years, we think they're going to be able to double the size of GDP in line with their stated goal. So we think it's a key region that people should be looking at investing, particularly given that since February, valuations have come down a lot.
Mike, thank you so much. Mike Bell, there, global market strategist at JPMorgan Asset Management. Are you spending less? I mean, maybe we should do like a Bloomberg surveillance poll, because I feel like I'm still spending just as much as I was a couple of months ago.
I think certainly over the pandemic, I spent less, and so have some savings to spend in the future, yeah.
There you go. I mean, Miller, always a good benchmark on consumer spending, so we'll get to Miller on that in a second. Coming up, we'll take you through a day in the life of a trader. That's our big take story next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, Jan Hatzius, Goldman Sachs chief economist, at 7:45 a.m. in New York, 12:45 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz in New York with Francine Lacqua in London and Matt Miller back in Berlin. Well, trading requires constant vigilance and the ability to adapt and profit from disruptions. But what happens when the act of trading itself is disrupted? Our Bloomberg reporter sat down with a few traders to discover their day-to-day.
Taking emotion out of it completely, staying educated, very, very important. Staying disciplined, right, and staying patient, especially in an environment like this where we have volatility, like unbelievable intraday.
There's a psychology around understanding what's out there, not fighting the market, and being respectful of the market and what the market's telling you, and being really cynical about every input that's in your mind and questioning every assumption, which can be tiring sometimes, but you have to do it.
I think it takes discipline and sort of ability to disentangle, and I know that sounds weird, but sort of disentangle the decision-making process from the day-to-day.
I think having that early sort of insane volatility of crypto has, helped me manage volatility and understand that I could always be off by an order of magnitude, and so to plan for that.
Well, you take all crypto, all tokenization, all DeFi, everything related has gone to $2 trillion. So everything that we do day to day that people don't even realize yet, that market's telling you is going to be disrupted.
There's an opportunity when there's lots of excess volume, and we've seen that with a lot of these meme stocks, the retail engagement. By the way, the retail engagement from my perspective is unbelievably good for us. All right? I am a big fan of growing our ecosystem.
I'm so glad to have Matt Miller back, our great watcher of cryptocurrencies. And what are you watching today? Tether? Ether?
Well, I think the Tether story was absolutely fascinating from the cover of Bloomberg Business Week over the weekend, especially considering what we're watching happening in China, right? Each Tether coin is supposed to be backed by $1. We recently learned no longer $1 in cash deposits, but $1 in cash equivalents. And we found out also Zeke Fo did a great story I think he's a Pulitzer Prize-winning journalist. Zeke Fo did a great story pointing out that some of that is backed by commercial paper and possibly even Chinese commercial paper. So it's possible, we don't know because it's such an opaque system, but that some tethers are backed by commercial paper in Chinese developers, and that would be a real problem because it's a huge part of the crypto trading landscape.
Yeah, it certainly will. Look at that. There you go. The Galaxy Crypto Index in the week. Yeah, I think it's a week. Actually, in the year, gaining some 491%. Now, coming up, we'll bring you more of our exclusive interview with the Hong Kong Chief Executive, Carrie Lam. That's coming up shortly, and this is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua in London. And I've got to make quickly, Francine, a Surveillance Early Edition correction. I mistakenly awarded Zeke Fo, who did our tether reporting for Business Week over the weekend, a Pulitzer Prize. Actually, it was Zach Miter, another Bloomberg reporter that I was thinking of. It's easy to understand how I would make that mistake, right? Zeke Fo, Zach Miter.
You can also give me a Pulitzer. I don't mind, Matt.
Yeah, well, if I'm passing them out, you would definitely get one, you know? But I'm not, unfortunately, the body that awards those. So Zachary Miter, congratulations. I'm sure Zeke is going to get one eventually, you know, in the long run.
At a later date.
Yeah.
Now, Matt, Hong Kong Chief Executive Carrie Lam has defended COVID-19 travel restrictions that are frustrating global businesses, signaling curbs will stay in place for the foreseeable future, even as Singapore opens up. Well, she spoke exclusively with Bloomberg TV's Haslinda Amin, stressing that even a single fatality from COVID-19 would cause a major concern in society.
From the mainland perspective, is the practices adopted in Hong Kong should be as aligned as possible with the mainland practices. But they also accepted that we are operating under a very different regime. So the discussions between the two sides are meant to find a way forward that respecting the differences in the systems between the two places, that there could be assurance that we will not be sort of the weak link in terms of COVID-19 control.
For Hong Kong to remain a international financial hub, it has to be open not just to China, but the rest of the world. Are you concerned perhaps that your competitiveness will be impacted because Singapore is opening up and there's great competition between the two cities? Might Hong Kong lose its competitiveness?
Of course, I am concerned, and we are working very hard to resume normal travel in a gradual and orderly manner, both with the mainland of China and with overseas places. But as a chief executive in Hong Kong, I am also duty-bound to protect my people. So any fatality or increase in fatality will cause a major concern in society. So in dealing with the public health crisis, we have a lot of factors to take into account. It could not be just a single factor of a financial center. But coming back to financial center, I think Bloomberg knows better than everybody that we are doing very well.
A wall of worries for international investors, among them the Anti-Sanctions Law. Lots of speculation. It's been delayed, whether or not it is on the back burner or whether or not it is dead. Talk to us about what's happening with the Anti-Sanctions Law.
Now, first of all, the Anti-Sanctions Law is a piece of national legislation. So there is a mechanism for national legislation to be applied to Hong Kong by an act of inclusion into the Annex 3 to the Basic Law by the National People's Congress Standing Committee. Secondly is nobody could dispute the extension of this law to Hong Kong if needed, because this whole round of sanctions by the United States arose out of Hong Kong. I am a sanctioned officer. I'm still an officer being sanctioned. So the time will come that if Hong Kong is put in that sort of situation, then of course we will follow the central authorities' direction to implement any anti-sanctions measures. The most important point is I have been given to understand that the anti-sanctions law at the national level is a toolbox. And in extending a toolbox to the Hong Kong Special Administrative Region, the central government will take full account of Hong Kong's unique status, especially her status as an international financial center. So the final point is I have no timetable.
Well, that was Hong Kong's Chief Executive Carrie Lam speaking with Bloomberg's Haslinda Amin. Now, Tom Keene, co-anchor of Bloomberg Surveillance, also joins us. Tom, I don't know whether you're still looking at some of the employment numbers or whether you're focusing full throttle on WTI.
Focusing on a lot of things, including what's going on at the World Bank International Monetary Fund meetings. They begin today. Gorgieva under siege. You know that, Francine. Some anti-vaccine protests as well. And then there's the markets. Let's look at oil. Let's look at oil very quickly here with inflation adjustment over 70 years, but also an approximation of the fact we have rising incomes. This is very, very important, and it really changes a classic chart. OPEC 1, if you will, then OPEC 2, the crash in 96, Persian Gulf War spike, and then up we go with the China boom. And Francine, the real story here is how shockingly cheap oil's been for the last number of years. We're basically just back to trend.
We are back to trend. And Tom, I just, at some point, though, when you're used to all this cheap money and cheaper fuel prices, I don't know what that means for some of the margins, for example, if you're a big company out there.
Well, the margins is going to be a game. We dive into earnings week here. It is Columbus Day, but with that said, John and I are getting ready for earnings. We see them with JPMorgan.
Earnings, yep.
It's going to be a massive mystery, including Jan Hatzius with us. He's got a modest markdown on GDP.
Yeah, repricing all of the market. Tom, thank you so much. Tom Keene, their co-anchor of Bloomberg Surveillance, joining us. Now, look at what else we're watching, and you're looking, Matt, at the IMF.
Yeah, I think the IMF story that Tom alluded to there is really fascinating because this body that was so important for, many post-war decades, including in my youth, has become less important as the Federal Reserve and other central banks more broadly affect what happens in emerging economies. So it'll be interesting to see what happens here.
Yeah, I'm looking at the Bank of England with Bank of America, for example, Matt, saying that they will actually hike interest rates in December. And then Kit Jukes, of course, with the best notes, talking about sterling silliness. Now, more Bloomberg Surveillance up ahead. We'll hear from Jan Hatzius of Goldman Sachs, Claudia Saim, stay-at-home macro founder, amongst others. This is Bloomberg.